Valuation is the process of estimating the value of something. Business valuation could be used to determine the value of the total business or certain aspects of the business. So valuation is the process of estimating the value of something, and businesses can be valued for the total value of the business or certain aspects of the business. Our firm does a lot of 409A valuation, but I want to mention that, 409A valuation briefly is an estimation on the value of common stocks issued in private companies. For companies that are publicly traded, it's really easy to determine the value of their stock. That information's on your phone. At any given second, we can tell the value of one share in Apple or Disney. But for companies that are private, we need experts to determine the value of their common stocks. Later on in the presentation, Kislay will explain more thoroughly about what 409 valuation is and how we can do it. But I just wanted to take a moment to explain that valuation experts are used in many more situations. For merger and acquisition, and real estate transaction, people want to know the value of the company they're purchasing. It's also used to determine the asking price. In litigation, I've been involved in cases where we use experts to determine the value a business have lost in profits due to a breach of contract. Valuation is also used in family law at dissolution when ownership of the company is divided, and in estate planning to determine division of assets. Since valuation is an estimation, are there consequences for wrong guesses? Of course, undervaluing stocks may result in the IRS penalties and loss compensation. We'll go more into this later on in the presentation, but deferred compensation from the current and preceding years are taxed immediately if they're not assessed or valued correctly. There will be accrued interest on the revised taxable amount. In addition, there's a 20% penalty on all deferred compensation. There are safe harbor, and we'll go into that later on in the presentation. Wrong valuation can also mean over litigating a case. Lawyers can spend time and resources to prepare for trial, and then at the end, the experts can say, the parties didn't suffer any damage or lost profit. So 409A comes from Section 409A of the Internal Revenue Code. It became effective January 1st, 2005, as part of the American Jobs Creation Act of 2004. Legislature came up with this code because of Enron. Executive were using deferred payment plans to access money right before the company filed for bankruptcy. In other words, the executive granted themselves large stocks option and then accelerated the vesting of their option and then exercised and sold their shares when it was trading at an all-time high, but in actuality, the stocks didn't have much value. So now companies need to give employees stock options that have a price which the stock can be brought exactly or similar to the fair market value of the common stock at the time the stock was granted. So Section 409A addresses deferral compensation. There are many times when these are necessary. 409A valuation is needed before you issue the first common stock option. It's necessary every single time there's a round for venture financing. The IRS requires it to be done every 12 months or after a material event, whenever the company is approaching an IPO or a merger or acquisition. And then I'm going to pass it on to Kislay to talk about the approaches.
Hello everyone, my name is Kislay and I work from Santa Clara office. Valuation is a very subjective matter. Sometimes valuation is changed if the idea is very bright and the startup is very hot area, the beta version of the product is released and the customer is interested in the product. a key person has joined the company. For example, Elon Musk joined the board of some newly funded startup, then the valuation will skyrocket right away. What I feel that valuation is the game of negotiation. A true valuation is something the buyer is willing to pay and the seller is agreed to sell. See the example of stock market. At certain price, people are buying the stock and selling the stock. In case of litigation, both the party agree on some pricing. Valuation report just provide a tool for negotiation. Think about it. Sometimes valuation is done by both the party in litigation and they're miles apart and they start negotiating. So in case of VC funding, sometimes there are bidding war for hot startup, and sometimes VC companies are in a driving seat, negotiating how much stock of the company they will take, and sometimes the startups are in the driver's seat when the idea is very bright, when the multiple VCs are willing to invest, so they negotiate with the VC. Apart from the negotiation, valuation sometimes needed as per the guidance by regulatory authority. For example, IRS expect the entity to get the valuation under Section 409A, that certain to do the certain stock compensation accounting and taxation. So in this section, we'll break down the valuation into 3 steps that involve the 409A valuation. The first step is to calculate the enterprise value. This is one of the most important step for the valuation, and this sometimes is very straightforward if you are doing a 409A valuation for a company that immediately got fundraised. Because if the company got fundraised, that's the true valuation, because somebody is willing to invest at certain price, and those investors are aggregated investors, and they know where they are investing and what is the correct value of the enterprise. So once the value of the enterprise is calculated, then we need to determine the value of the common stock. So this step takes the enterprise value and divide it among all the different classes of stock to determine the current value of the common shares, what is also known as the fair market value. And this step also takes into the account of all the economic rights of each share classes. For example, if the company has a preferred shares, warrants, common stocks, then and those preferred shares may have a different economic rights. For example, they have a liquidation rights. Warrant has some other rights. Let's say enterprise value is $25 million. Based on the liquidation right, the preferred shareholders are going to get first $20 million proceed. In that case, common stock will get only $5 million, and the fair market value of the common stock would be less. So this becomes very complicated if there are series of preferred stocks and the common stock, because then we have to consider the liquidation right and economic rights of preferred shareholders. And after this step is done, the third step is to apply for discount for lack of marketability. So these steps calculate the common stock and the fair market value of common stock, and then apply the discount. So generally the private companies, they are not publicly traded and they are not liquid company, and the common shareholders or the employee of the company, their fund gets stuck. So it's not fair to charge them the complete full price. So the discount is applied for the liquidity. So in this step, we analyze the volatility of the industry and stock market and come up with a formula to arrive at DLOM. So next, we'll discuss different valuation method. In the 409A valuation work, there are 3 main methodologies: market, income, and asset base. These can be used in combination with each other, and the method may also change as the company mature. For instance, it's very common for early stage company to rely heavily on a market approach, while some mature growth rate companies are more likely to use income approach. The market approach. This is for an unprofitable company. This is generally used for an unprofitable company and early stage companies where it is difficult to predict the long range financial performance. For example, if the company is unable to provide budgeted financials for next several years, this approach can be used. How does it work? This market approach is a relative valuation method, which means a company is compared to a set of publicly traded companies that are similar, usually in the same industry. And for the profitable company, it takes generally it takes the multiple of EBITDA. But in case of non-profitable company, it takes the multiple of revenue. And there are limitations because oftentimes the company comparables are not the correct representation of the peer group, and there are different metrics and dynamics. The public company have more access to the funds. The private company has a limited accessibility, so there are some limitations. Next is income approach. Generally, the income approach is used primarily by the companies who has achieved some financial milestone, and they have a high degree of visibility and predictability in their financial performances, and they can see the light, and they know that when if they are profitable and how their budgeted financials will look like in next few years. So this methodology assumes that company value is determined by the receipt of the future profit stream. The company, for this purpose, we use the company's long-range financial projections to determine these income, what these income levels are, which are then discounted back to what they would be in today's dollar, which is present value. So once we have the profit for next several years, we calculate the present value of the those profits, and this is also called discounted cash flow method. So the benefit of this methodology is it is directly influenced by the future expected profit from the company. The downside is that this requires reliable long-term forecast that must be substantiated. The third approach is asset. When it is used for a venture-backed company, the asset approach is rarely used when it is typically in a very, very early stage, even before the pre-angel, the company has just started, there is no funding, nothing going on, then this can be used. So this approach uses replacement cost to determine a company's enterprise value. For this method, the appraised value of all assets and liability of the company determines its enterprise value. The benefit of this approach is that it doesn't require any kind of forecasting because the potential growth of the company is completely ignored. This is also a downside to the asset approach. Once the company enterprise value is determined, the next step is to assign various equity classes to their shares of the company. So some startups also use option pricing model, and there are many, but the two of them are most used, like Black-Scholes model and binominal model. So when it is used, the option pricing model is frequently used for companies. They are still too early in their development to identify their products and exit scenarios. So the 409A has a safe harbor. The IRS provided some safe harbor, and if these requirements are met, then the burden is on the IRS to prove that valuation was grossly unreasonable. If the valuation doesn't fall under safe harbor, then the burden of proof falls on the taxpayer. Generally, the safe harbor insulate you from persecution. Luckily, the IRS has provided avenues for a company to safely offer deferred compensation. If you have a safe harbor, IRS will only reject the valuation if they can prove that it is grossly unreasonable. The burden of proof is IRS to prove that you are in error. Safe harbor 1. The safe harbor 1 is fair market value of a private company stock is estimated by a qualified independent appraiser. So while it is the expensive option, but this is the safest because the only condition is that the firm should follow a consistent methodologies in valuation. The code section doesn't say who is what is the qualification of independent appraiser, but the safe harbor 3 does provide some guidance based on which we can say that a CPA can do the valuation. The safe harbor 2 talks about fair market value. It should be based on a formula, like for example, multiple of book value or multiple of earning or combination of both. And the usage of these formulas should be consistent across the board. If somebody is, for example, joining the company or somebody is leaving the company and some settlement is going on, then this valuation method should be same across the board. It should not be that you are using a different methodology for a different purpose. 3 says that fair market value is estimated by a qualified individual who is not a independent of company. This is a little weird to hear, but it says that for a smaller company, which is a private company and has not publicly traded stock and is less than 10-year-old and has no stock that is considered as a call or put similar derivatives, the valuation can be done by somebody within the company who is not a independent. But there are some certain conditions. That the condition is that the individual appointed to do this valuation must be at least 5 years experience in the field of valuation. This includes business valuation, private equity, investment banking, secured lending, or a financial accounting. This can be a little tricky because there is a room for subjectivity. IRS upon discretion may determine that individual who is in valuation did not meet the required standard. So this is we have changed the name of the sample report that we have done. So this is how we do the 409A evaluation. The first page is our letter and certification and what was the purpose and scope of the 401, this 409A evaluation, and what is our finding, what is the per share value, and then we sign it, and we also mention that who has done this valuation. That part is missing here, but we do write the names. And this is pretty much we cover here. We provide a executive summary, and we discuss in this report that the valuation approach and which method we have considered and why we have considered this method for this particular company. And then we provide some disclaimer and point 3 that we have assumed certain things and there are certain limitations. We disclose those items, and the main thing is about these exhibits where we have done our calculation. So as you can see that in executive summary, we talk about company background, what are the value conclusion we have done, what are the what IRS says, and some definitions and the purpose of the valuation. And the second approach, we discuss the method that I just discussed, like income approach, and generally majority of our clients are in a service business, so and they have a income statement, so we use income approach, which is a discounted cash flow, and then we discuss the certain assumptions and limiting condition. For example, the scope and the use of report, going concern assumption, and also we disclaim that the projections are provided by the company, and we have done this calculation based on the projection provided by the company, and we have relied on their forecasted data and certain other testimony and legal assumptions that we provide here. And the last few pages are the calculations. So you can see here that we discuss the company financial metrics. We calculate the historical data of the company for the last 3, 4, 5 years, and the projection for the next few years. The more the better. So we use at least 7, 8 years of financials. And in this one, we calculate EBITDA and and the net cash flow that company is going to generate, has been generating and will be generating. And then we calculate certain performance metrics and the different ratios. And based on these ratio, we calculate discounted cash flow. And then we calculate the terminal value of the company. For example, in this case, the equity value under DCF is $8.6 million. And based on the number of shares issued, we calculated equity per share. So this was relatively a simpler method. We have not calculated the discount for lack of marketability, but in some other companies we have done it, particularly when there was the company wanted to do little lower valuation for the stock options. You guys have any question? Francisca, you can go back to the slide. You can put the slide back, and Narendra is going to cover the rest of it.
Hi, good morning, everyone. This is Narender Singh. I'm CPA with the Status Office. I'm with the firm for last 8 years. So I would like to cover 3 aspects of 409A. So what is the impact of valuation on the stock options and 409A penalties, and then we'll go with one example. So you will have better understanding why 409A valuation is important and what we're talking about the fair market value of the stocks. So as you know that there are different kinds of stock options: NSO, ISO, SAR, restricted stocks, and phantom stocks. Basically, we just want to know like where 409A will be applicable, what kind of stock options 409 will be applicable. So 409A will be applicable to NSO, ISO, SAR, phantom stocks. So the rule of 409A states that exercise price must be equal to or greater than the fair market value on the date of the grant. So all stock options are required to issue at the fair market value at the date of the grant. The actual issued price could be higher than the fair market value, but it should not be lower than the fair market value. And we'll see like what are the consequences if stocks are issued less than the fair market value at the time of the grant. If you see in case of ISO, if shareholder is 10% or more shareholding interest in any company, so fair market value, the exercise price should be 110% of the fair market value. So this is a rule, so everyone should adhere to the rule. And while determining the fair market value, the private company must use the valuation method, which meets the criteria of Section 409A. So that's why 409A valuation is very important in case of stock options. And there are the one stock option, restricted stocks and performance shares, where 409A is not applicable. Why this is not applicable? Because the shares are transferred to the service provider at the time of grant, so there is no deferral. So 409A basically applicable to deferred compensation. This is not applicable to any kind of like right away. If someone is paying right away, so it will not applicable to that. So, and we also know why 409A will be introduced because of the Enron. So that's why 409A is applicable to all stock options other than the restricted stock. So basically, we just want to see what are the penalties if 409A valuation is not done correctly, or the stocks are issued at less than the fair market value. So it will become the huge tax consequences to the employee. In this case, all deferred compensation from the current year and the preceding years become taxable to the employee immediately. Employee also subject to the interest on the revised taxable income. And on the top of interest and tax, employee also subject to up to 20% of penalty on all deferred compensation under Section 409A. And if you can see, like, this will create the huge tax burden to the employee. So employers should always consider this penalties while issuing the stock option. And employer always go with the 409A valuation. And stock price should always be either fair market value or higher than the fair market value. So we'll go through one example. This example will give you a better idea. So what kind of penalty is applicable and why 409A valuation is really important. So if we say like our employee with 100,000 options vesting over 4 years, an employer is giving to one of their employees and strike price is 0.25. But after 2 years of the grant, IRS comes to audit and they review the 409A valuation, and IRS determine that actual strike price was $1 instead of 0.25%. So it means like employee cannot go with the safe harbor because a strike price is below 25% of the fair market value. So it is up to IRS. Now IRS will determine that whatever the employees are getting the options, so everything will be taxable in the second year. And I'm taking the federal rate 37%. This is the maximum rate for the individual. So individual or employee can be their net the taxable income could be like less than 37%. So I'm taking the example of 37%. And on the top of the paying the federal tax, employee also subject to up to 20% penalty under Section 409A. And if you see, like, it doesn't matter that employee did not exercise any option to sell a single share. Even though employee never exercised any option, still employee had to pay tax on the difference of whatever the strike price and the fair market value at the time of the issuing the option. And also it will not matter even though employee exercise, but there's no one who can buy the stocks from the employee. So employee is stuck in this case because employee got the stock option and employee did exercise, but the employee cannot sell these stocks to anyone, but still employee had to pay interest, penalties, and federal and state taxes on this underpayment of the actual stock price minus the strike price. So in this example, like we are saying the grant strike price was 25.25 and current fair market value at the year of 2 is $5 and number of common stock issued to that particular employee in 2 years is 50,000, 25,000 every year. So in this case, the taxable income to the employee would be $232,000, which comes with the 50,000 stocks into 4.75, which is like the actual fair market value at the time of the at the end of the year 2 minus 0.25 strike price. So federal tax will be payable $86,000 by the employee. So this is the tax consequences to the employee. And on the top of federal taxes, the employee is also subject to 409A penalty, which could be up to 20%. But the penalty will be applicable for prior years than the year, not the current year. So IRS comes in the second year, so penalty will be applicable only the first year. So that's why I'm taking the 25,000 shares. And the difference of the actual fair market value minus strike price, $4.75. So penalty could be around 23,750. So total federal taxes and penalty, the employee is subject to $109,000, even though employee did not receive cash in reality, or employee not able to sell those stock options shares to anyone else because there is no marketability of these shares. So employee is stuck in this case. So if we see like, okay, employee liability is approximately 47% of the taxable income. And this is a huge tax consequences to the employee. And also on the top of the federal taxes and penalties, employee is also subject to state and local taxes. and also state penalties. California is really aggressive in case of stock options, and California are always looking into the valuation, and they also looking into the what kind of penalty they can apply. The top of this, employee is also subject to tax and penalty for the future grants. It will continue till the grant vest. For example, like in this example, if the fair market value continue to increase and tax liability increases too, so option strike price was 0.25, but the fair market value at the end of year 3 is 6.5. So in this case, in the third year, the employee gets 25,000 shares. So taxable income to the employee would be around $156,000, which is 25,000 into 6.5 minus 2.5. So federal tax is payable in the year of 3 is 57,813 by the employee, plus state and local taxes. So you can see that 409A valuation is really important, and the employer will not get much benefit by lowering the price, but there are huge tax consequences to the employees if they issue the stock options below the fair market value under Section 409A. So basically, what is the moral of the story? So when determining the fair market value, the private company must ensure that their valuation method meets the Section 409A requirement, and always retain a qualified and independent 409A valuation firm, and make sure that the work is defensible so that safe harbor applies and option grant remains tax-free to the employee. So you can always say that there are huge tax consequences to the employer, not the employer, basically employee, but ultimately those stock options may become void, or employer may force to put void on those stock options because of the tax consequences to the employee. So IRS is kind of aggressive. IRS can always look into the 409A valuation, and IRS can always go back and see if that valuation is correct or not. And if it's done by independent valuer, definitely you can always get more kind of like argue that your valuation is correct and the fair market value is correct in that case. So it should be certified, and the 409A valuation report should be certified by the independent firm, and that is also recommended.
Thank you everyone for attending.
Thank you.
Thank you, everyone.
To everyone.
Thank you, everyone.